Okay, good morning, everyone, and welcome to our monthly webinar. It's going to be great today. We have got exactly the right lineup for this time in history. So just before introducing the speakers, just a couple of items of housekeeping, if I could. So firstly, to any media online, if you want to extract or use any of the content from this presentation, please contact either us or Jez at Network. Also, the Q&A function is now live, so I'll curate any questions if time allows at the end of each of the segments. So our order today is Naomi Fink, then Fergus McDonald from the fixed interest team on the back of the OCR, and then Mei Zi on the back of earnings season. So first up, we're delighted to host for the first time our colleague Naomi Fink, who is the Chief Global Strategist for the Nikko Asset Management Group. So yeah, we're really stoked to have you here. Any of the viewers online who's familiar with or looks at the financial media in the Asian business hours it's highly likely you've seen Naomi already with her regular pieces on the media. Yeah, so, and as a reminder also, Naomi's joining us in person in September for the lunch series. So I've seen the presentation, Naomi, it looks awesome. We'll share it and move as you direct us, but over to you. Thank you very much.
Yes, thank you very much for having me today. It's a pleasure to present to New Zealand today. What we are going to look at today is how Nikko's global strategy has taken a look at the uncertainty that has arisen, especially around the trade tariffs situation in the US. So our presentation is called "We Are All Bayesians Now." Part of this is because the last time I gave it, it was to a bunch of central bankers when I was invited to a central bank conference. But no, most of it has to do with dealing with uncertainty. I just wanted to first identify what I meant by Bayesians. Now, typically, when one looks at financial markets and trying to come up with good assumptions around financial markets, typically it's very usual to employ a frequentist framework. So that means you use history as a guide, and you basically look at the frequency that occurred in history and project it forward. But under uncertainty, it's possible that history doesn't serve as such a good guide. So a Bayesian framework allows you to assign a degree of belief to something and then update as you get new incoming data. So that's why we are all Bayesians now. And then I will explain a little bit more by looking through our framework. This is the framework that we applied in the extraordinary Global Investment Committee held in April, where we came up with 3 different scenarios for the US economy and how we thought the global economy would evolve around those 3 scenarios. So just to start off, the next slide, please. So just looking in summary at some of the considerations that drove our extraordinary investment strategy review. So we had, as everyone knows, the reciprocal trade tariffs announced on 2nd April, enacted on 9th April. Then we saw a lot of market disruption. Uncertainty grew about the direction of the US economy, not only policy, as well as that of its trade partners. And then we had an escalating trade war that at first seemed really bad, and now seems a lot more contained. Although tomorrow, who knows? And as such, we continue to apply our scenario framework that we deployed on 10th of April. So in our scenario framework, we looked at 3 probable scenarios, so ones that were associated maybe not with above 50% probability, but high minority probability. So the first one, and then this is the most positive one, is that of interim volatility. So we would have a 3 standard deviation move in equity volatility, followed either by immediate or phase stabilization, and I'll explain the trade context around that as well in a further slide. The next, then we had 2 recession probability scenarios, and one was with disinflation. So that would mean that we had a shortage of demand. We would have a slide in core PCE, and then that would allow the Fed to cut. And then the third one was a recession scenario with stagflation. So then we would have the slump in demand, but that would not outweigh the inflationary impact of tariffs, and then that would give rise to persistent inflation expectations. So those were our 3 scenarios. Can we move to the next slide? And then just taking a look at some visuals around the scenarios and why we constructed them. First, we saw the huge spike in April in US average tariff rates from between 3 and 4% of late to the highest in 100 years. And this is, of course, combining the implemented, forthcoming, and threatened. So that changes day to day. But even now, we're still at much higher levels than we were immediately prior to April. Next slide. And as a result, we also had a spike in trade policy uncertainty. And this is not such a long series, but if we compare it to 2018, when we had the America First trade war, we see that the uncertainty is multiples of what we had in 2018, just in terms of magnitude. Next slide. And taking a look at the potential impact on US GDP and core PCE, we relied on some of Bloomberg's breakdown of each type of tariff. So the China tariffs, the product-specific tariffs, Canada and Mexico, and the threats as well. And then we refer to their breakdown of impact from each type. Next slide. So then we extended the scenarios in the context of escalating trade barriers. What did we think the trade context of each of these were going to be? So the first, as I mentioned when I described the scenarios, was one that was characterized by interim volatility, but also from a trade perspective, that it would be followed by detente of a trade war. So we've got a lot of positive signals recently that this might be the likeliest outcome, but of course we're not certain on that yet. So in that case, we would have some impact on growth and inflation, but more temporarily. And while it might overall hurt growth, it might be possible to avoid US recession. So it would be a brush with recession, but then a rebound before year ends. The second one, disinflation, we anticipated that this would be consistent with some scaling back of tariffs, but that it wouldn't prevent US growth from declining because of the tariff uncertainty, but then also the damage to corporate investment and hiring because of the uncertainty, impact of other policies such as the DOGE austerity program, the either existing or threatened deportation of U.S. Citizens and undocumented workers, and the accompanied chilling of consumption. And in that scenario, we would have a demand drop that offsets any inflationary impact from tariffs. And this scenario on the upside, the Fed could deliver a series of rate cuts to allay the pressure from the demand drop. Now, the third scenario is the one with stagflation, and that might be one that the market was recently flirting with. It would be consistent with an escalation to all-out trade war, wherein the US consumer basically wears the cost of tariff plus retaliation, and the Fed is unable to cut much, so unable to offer any reasonable offsetting stimulus because of the inflation side of its mandate. And we saw this overall as probably the most negative of all of the 3 net, even though it wouldn't necessarily be negative on every single parameter. And we'll go into that a little bit. But even so, even in that negative scenario, we also saw some potential for opportunity. Next slide. So just taking a look at how we referenced the impact from things like uncertainty and the actual tariffs to growth in the U.S. and beyond. We took some of the IMF's estimates and extended those, and also had referenced some analysis done by some colleagues on the sell side at JP Morgan. So I've displayed a couple of charts here that show the greatest impact on the US, followed by Eurozone, China, and the world. And this was only 20% increase in tariffs. Of course, this changes if we had maximum tariffs on China, for example. But we just looking at the breakdown, it was a helpful guide in estimating some of our scenarios. Next slide. So I've got a few slides on the impact of our scenarios on various market parameters, and I'm not going to go through all of them in detail, but I will provide a summary of our thinking here. So here we have US GDP and CPI. So according to our three scenarios, very clearly you'll see that that the interim equity volatility followed by detente is our best scenario and our least volatile scenario. It has the narrowest range that's on the left-hand side here, the left-hand side chart. And our recession scenarios are in terms of growth, as recession is, much worse, with the stagflation scenario, although higher in terms of growth on average, because the decline in demand is offset by the higher inflation, but we have a much wider range, much more uncertainty. And that's also the case with CPI on the right-hand side, as we see relatively contained inflation and disinflation in the first two scenarios. We see significantly elevated, 1% above recent core CPI scenarios in our stagflation case in a much wider range. Next slide. So taking a look at the knock-on impact for a lot of our other economies, we didn't put any big assumptions on the inflation side, just simply because we anticipated, it was our prior, that in a trade war, then it would be a much more endemic U.S. inflation situation, even though we might have impact on growth elsewhere. So for Japan, for example, we see positive above potential growth in the first scenario, and the other two scenarios, we see it fluctuating with a range around zero. Not too much difference between the two, because one would involve stagnant growth with inflation in the U.S., which might be similar to a decline in demand in the U.S. Just the fluctuations and the potential for some interim negative readings. Similarly, with the EU, in the benign scenario of interim equity volatility and detente, we would see a rebound in until now stagnant EU growth, and in the other two, we would see a return to that stagnancy. And on the China GDP and CPI side, these scenario estimations very much focus on the fact that we also assume a steady deterioration going through our scenarios from 1 to 3 in trade conditions, with the stagflation scenario consistent with all-out trade war, and that's why you see GDP much worse and a much broader range for China in the stagflation scenario, and same with the deflation in China under the stagflation scenario in the U.S. within not only the pressure on demand, but then enhanced need for competition abroad. So that could serve as an additional deflationary force. Next slide. So looking at some of our rates and our bond scenarios, I won't spend too long here, but I will touch on what I had described with the Fed, that we had maybe some limited cut potential in the most benign scenario because growth would slow, greater cut scenario potential in the second disinflation scenario because inflation would slow significantly, but the Fed would be pretty much hemmed in the stagflation scenario. And as far as the BOJ goes, the BOJ doesn't really have very much room to cut. So if it did, it would be extremely limited. And the BOJ is also hemmed in by what looks like much more domestic endemic inflation. So we see probably still more upside there, and limited downside in the recession scenarios. And similarly, the ECB may have more room to cut in a disinflation scenario in the US, less room to cut in a stagflation scenario, but still remains on a cut path. Maybe I'll highlight some of the bond situations just because we did see a spike in bond yields across developed markets that came back down, or at least maybe most acute in the U.S. and Japan. I think there are a couple of similarities in bond markets, which is basically that the ECB, Fed, BOJ, they all underwent this zero lower bound exercise followed by quantitative easing, and they are all exiting the quantitative easing in a gradual fashion. So I think that makes the environment a little bit more fragile to begin with. Differences here, well, the US has a huge current account deficit that it needs to finance abroad. And then I think what we've seen a back and forth on from between the bond market and the U.S. government, where basically the U.S. government offers some policy the bond market either likes or doesn't like. It recently doesn't like has been a big theme, and that actually feeds back into U.S. policy too. When the U.S. sees that the bond market is reacting badly, it changes course. Like a lot of the tariffs were rolled back. So that's a very interesting dynamic, and that's also something that I'll go into further detail on, and how that feeds into our Bayesian framework. Next slide. Looking at foreign exchange and commodities, I think the main point here is that we think that the dollar is going to remain under pressure probably no matter what. Most benign scenario is consistent with the least near-term dollar weakness. Stagflationary scenario, even despite the Fed being hemmed in, might be consistent with even greater dollar weakness, just because of what we saw in the dynamics of the escalating trade war. We saw a flight from long-term U.S. assets. So it could be a sell America scenario if the market judges U.S. policy to have potentially endangered its ability to or endangered the full faith, credit, and taxing power of the United States. Next. And from an equity standpoint, I guess one thing to point out here is if we look at the upper left-hand chart and the S&P scenarios, as you see, the valuation scenarios are not necessarily the worst in the stagflation scenario, and that is because it's also, we were looking for it to be consistent with an escalating trade war. So what would happen is a lot of U.S. firms might get a bigger piece of a shrinking pie because of the tariffs. It might help them get a greater share of revenues, even if revenues shrink overall. But as you see below the valuation, we didn't really anticipate too great a difference in the index price scenarios because of the potential to weigh on earnings. And potential to weigh on margins. Next slide. So how did we actually distribute those probabilities in the Global Investment Committee? Well, optimistically, we did see the greatest probability among these three placed on the interim equity volatility, followed by détente. So on the left-hand side, we're looking at the distribution of our GIC voters. We have 9 voters, kind of like in a little bit central bank type formation, and 56% of our voters saw 50% or higher probability that we had the interim equity volatility followed by détente. That said, if we take a look at the 2 recession scenarios, we had a relatively even split And so how did that work out when we aggregated the scenario probabilities? Yes, we did have the greatest probability on the interim equity volatility, so almost 50%, but that also meant that if we look at it on a non-contingent probability, then we had over 50% as of April 10th assigned to either recession with disinflation or recession with stagflation. Now, since then, of course, because the news is steadily changing, that probability weight has most likely shifted. It's constantly shifting. But what I would say now is that we are nowhere near zero on the recession probabilities, even if they have decreased as a result of the most recent signals of the bond. Next slide. Next slide, please. Thank you. So I do offer a scenario on how we might apply the recent the framework. I'm going to skip over that, and then I wanted to focus on this key slide and what I mean by we are all Bayesians now. So what is possible to do if you actually have some sort of estimated framework of probabilities associated with an indicative market, like the bond market, is to try and infer from that which state we're likeliest to be in now. So then it's making use of those shifting probabilities. So on the lower right-hand side chart, looking at the U.S. Treasury yield, as you see, there were ranges that we assigned to different scenarios of the yield. Most recently, when we saw a spike in yields, when we saw a spike above to the mid 4% range, then that put us in the area between the detente and the stagflation. So that meant higher probability of stagflation, higher probability that we are in the stagflation scenario, and that's since receded. That was an indicator. I mean, it didn't necessarily mean that it couldn't change the next day. It did, but it did tell us probably how the market was interpreting the event, namely that the escalation in the trade war, the uncertainty was more consistent with the stagflation scenario. Since then, we've had a bit of détente, and now we're less consistent with that stagflation scenario, and now more consistent with the détente scenario. So I would just like to skip forward a little bit because I know we have some limited time, and I've provided some charts of just general market observations around these events and looking at how we look at the indicators amid uncertainty. So I'd like to skip this slide, please. So one thing that might be of interest is foreign exchange. We saw a sudden rebound in the yen with risk aversion at the outset of the trade tariff threats, and we've seen a bit of a reversion. Just to put that in context, on the right-hand side, I offer a couple of different measures of fair value. The top one is more of an uncovered interest rate parity measure. The middle one is purchasing power parity. I would focus on the top one and where we are. So even when we went to the low 142 range in dollar yen, I would highlight that that's well within the range of fair value and uncovered interest rate parity terms. It's not even at the bottom of the range. That's in the mid 130s. So that gives an indication of where we can go, where and still have a yen that's not overvalued. So then if we do get that stagflation scenario again, do not discount going into the mid 30s. Next slide. I would like to skip over this one in the interest of time. Another indicator to take a close look at US sentiment. Now, I know Michigan's sentiment has been much more extreme than other measures of US sentiment, but one thing that it clearly shows is that sentiment drops as inflation expectations rise. Um, do we expect inflation to be at 6.7% in the US next year? I certainly hope not. But it gives a clear indicator of how sentiment can be very quickly damaged by a lasting persistent spike in inflation expectations. So it is necessary to get those down, and perhaps that also sends an indicator to the U.S. administration about how it might respond to bond market moves. So I know that we're now up on time. So I'd like to hand it back to Stuart and maybe take some questions.
Yeah, that's an awesome presentation, and I think we're okay sharing this. It's all gone through compliance, hasn't it, Naomi?
As far as I'm aware, it's gone through
Let's say yes then.
compliance.
Okay.
Um, so
Yeah.
I maybe check with these sheets on, please.
Okay. I think we're okay on this side,
Okay.
so that's fine. Hey, I've got a couple of one question from me and one from online. The GEC, the Global Executive Committee, heard quite a lot about the activities which from you, which I think were around your the central bank meetings that you attended or the conferences that you attended and the panels. If you could just take us inside the room a little bit without betraying confidence, is there anything about your interactions with either the panelists or the central bankers that you thought, wow, never thought of that? I mean, you have an abundance of resources, but if you could just give us an insight into in terms of what perhaps really worried some of the most powerful minds in the world.
Well, one thing that I think is becoming increasingly obvious, and I don't think this is a secret in any way, is that it is very difficult to find substitutes for US Treasuries in global reserves. So even though it's unlikely that US Treasuries are going to disappear or they're going to be suddenly supplanted by another asset class, it's at least becoming more apparent that perhaps we need to develop more diverse reserve assets. If we take a look at the composition of reserves, then 58% is in dollars. So that's a higher representation than the US in trade or in even in global investment in GDP terms. So, how do we achieve this? Of course, it doesn't come overnight. But then I think the central banks, just like many market players, have to start thinking about a world in which US Treasuries are not a default risk-free asset. So even if you do have your majority in US Treasuries, does it need to be 58%? Possibly not. So perhaps what we see over time is the maybe more active development of alternative reserve assets to better diversify global reserves.
Yeah, that's I didn't know that that was going to be the answer, but it actually dovetails nicely into the question that we have online, which is, I think you said Sell America, or you referenced Sell America, and I think that sort of is interesting to contemplate, like the safe haven status of America versus your home market of Japan. Could you just talk a little bit about that? Because you sort of have the same issue, if you like, with share of GDP and all the rest of it. And what are the risks you see about, everyone's talking about Japan as one of the safe havens. So could you just sort of take us inside that a bit, please?
Sure. So firstly, I would like to preface my comments by noting a figure here that in purchasing power parity adjusted terms, Chinese GDP is greater than US GDP. So do I think that instantaneously means that all capital is going to leave the US and head to China? No, I do not. But at the same time, when we look at some of the recent market talk, the arguments that we saw circulating in the market, that of US exceptionalism combined with China being uninvestable, these to me represent two extreme positions. And I think we probably need a healthier middle ground. I think China is too large a market to be uninvestable. And then when we talk about exceptional, the US is exceptional in many ways, but it's unlikely that we will see one market dominate always and forever, especially because most countries, institutions, and markets develop over time. And so I think most recently we did have a lot of investment in the US, especially in technology. We had a lot of conducive financial conditions, the monetary liquidity, fiscal policy. But these things too are not are not absolutes. They're not constants. So what we did have is a big support to U.S. GDP. Going forward, how is that going to play out? I don't think it's doom and gloom, but one thing that I wanted to highlight is that even policymakers put too much focus on labor productivity, saying U.S. productivity is high. But of course, labor productivity is going to be high if you make a huge amount of investment because you're putting the big onus on capital as a production factor. What you need longer term is for total factor productivity. So that's kind of like the product of technological progress and innovation to grow. And that's actually that's pretty stagnant right now, or it's not too different from Japan's total factor productivity growth of under 1%. So what needs to happen in the future? Well, simply that investment needs to broaden out in terms of productivity. It needs to go to other sectors. And just that segue to Japan. Japan may be client number one to those investments that the U.S. has made. Japan has an aging population. It has a declining population. It has chronic labor supply shortages, and that's very instrumental in keeping this virtuous circle between wages and prices intact. But longer term, what does Japan have to do? It has to boost productivity. And how is it going to do that? Not only by harnessing its human capital, but also implementing a lot of technology. Some firms have already started doing that. So they're taking that cash that they built up over the deflationary lost decades, they're raising wages, they're investing in technology, and that should lead for at least some firms, hopefully most firms, to increases in long-term productivity. So the U.S. should see this and figure out that that here you have a whole country that's kind of begging for those productivity improvements. And nobody in Japan, unlike in the US, is saying the robots will have our jobs because we need to increase that productivity. We can already raise wages and invest. So I think that there's a lot of potential for Japan to grow above potential, which is very low. It's only 0.5%.
Perfect. Thank you very much for that answer. That's great. Yeah, I found that really interesting, and I'm sure demand will bring you back to our shores in our online webinar. So we'll release you for the day and enjoy your morning in Japan, and we'll move on to Fergus McDonald from the fixed interest team. Thank you very much for coming on, Naomi.
It was a pleasure, and thank you.
Great, thank you. All right, I guess in this forum, Ferg needs no introduction, but he comes to us at a great time, just post the budget and post the OCR and the monetary policy statement. So over to you, Ferg.
Thanks, G. Certainly, it's been an interesting month, and Naomi's talked very well about global environment, global scenarios. I'm going to turn a little bit to New Zealand, in particular, interest rates. And in my little 15-minute slot, I'm going to touch on the New Zealand budget, the RBNZ statement that we had on Wednesday. I'm going to talk a little bit about market pricing and what that is indicating. And also, I'll just touch on credit margins as well. So off we go. Over May, we've had the budget and the RBNZ policy statement. They're both interesting in their own way. The budget deals with New Zealand fiscal settings, and the RBNZ deals with monetary policy settings. Pretty obvious. But if both of those monetary and fiscal can work in tandem, to achieve the inflation, growth and employment objectives that they have, or RBNZ inflation particular, then neither needs to work too hard. Neither dominates one or the other. And in general, we kind of saw this kind of happening with Nicola Willis's budget. The government has reprioritised spending. If it wasn't for the pay equity changes, the numbers would be very much in the negative, and that wafer thin surplus back in 28-29 would be quite a large deficit. But there was very little new spending, which actually helps the RBNZ achieving its sole inflationary objective. So I think that kind of at the moment we've probably got fiscal and monetary policy kind of working a little bit hand in hand. There was a forecast return to economic growth after 2 years of very lackluster growth. Both the RBNZ and Treasury and probably private sector forecasters are pretty much aligned for economic growth just below 3%. However, we did notice in the budget that the Treasury is assuming much more stimulatory monetary conditions than the RBNZ actually is forecasting on Wednesday. So the Treasury is really picking that the 90-day bank bill rate will stay at around about 2.5% over their forecast period out to 28 and 29. And that will be one of the inputs which actually gets them their wafer thin fiscal surplus in the latter years. If indeed the RBNZ doesn't deliver that level of monetary policy stimulus, perhaps calls into question, one, that the that fiscal situation will deteriorate and there'll be more government bonds on issue. Certainly over the next few years, around about 4 billion extra bonds were forecast to be issued. If the economy doesn't start to grow and start to grow quickly, just the amount of borrowing will need to improve, to increase even more. Turning to the RBNZ. The RBNZ delivered a 25 basis point cut that was universally expected, but you can probably call it a hawkish cut. It's the sixth consecutive meeting whereby the RBNZ has actually cut interest rates. And the bank is basically now considering when it is appropriate to sit back and just look to see what benefits that stimulatory settings will be engendering in the economy. And we are starting to see some signs of growth returning to the economy. The RBNZ, probably importantly, when they're looking at interest rates, talked about the neutral level of interest rates being somewhere between 2.5 and 3.5. So at 3.25 at the moment, they are in the stimulatory territory. So yet again, getting down to 2.5 as the Treasury is forecasting, maybe a little bit of a step too far. So will they pause? Quite possibly. And that is why it was probably a hawkish cut. So what is probably absolutely obvious, that the cutting of the Reserve Bank monetary policy stimulus is much, much closer to the end point than the beginning of their cutting regime. What is important, and what is important for us, is how long those rates are going to stay stimulatory for. The bank in its statement said that they are still anticipating that 50% of mortgages are going to be reset into new lower rates in the June and September quarter. So we would be expecting them to perhaps pause and wait to see what benefits that accrues. So I guess just turning then to kind of market pricing. On the monetary policy statement day, we did see 2-year swap rates moving up by 14 basis points. And market pricing has really taken out the expectation of a further 25 basis point cut in July. They're still pricing a reasonably high probability of a cut in August to 3%, but that is basically where it flat lines. So over previous months, there was a reasonable amount of anticipation that the Reserve Bank may continue to cut, but that has been priced out. I would say in the monetary policy statement, the Reserve Bank did mention the word uncertainty in excess of 150 times in that monetary policy statement. So, and they did also produce a number of scenarios for where interest rates would go. But at the moment, 5.5% from where they started from to 3.25% and most likely 3%. That's a large cut over a short period of time, and a pause is appropriate, and a pause is what we're likely to see. Just turning to mortgage strategy then, and Karen Silk, one of the deputy governors, assistant governors, said, gave a little bit of mortgage advice, which it probably shouldn't, but she basically said that it's time to think about fixing mortgages. There will be competitive pressures, which mean that banks will potentially trim mortgage rates a little bit more, but at term rates in the high 4% seems quite attractive. Got to remember two things though, that people obviously will look quite closely at what's happening with 2-year swap rates, 3-year swap rates, and think that that's where mortgages should be. It is an indicator, but the Reserve Bank, banks, when they're setting their mortgages, look at their total weighted cost of funds, and with term deposits continuing to kind of fall, and interest rates in the very short end continuing to fall, the weighted cost of funding from banks will probably continue to drop, even though we've seen perhaps 2-year swap rates kind of rising. So I don't think that just that we've had swap rates rising will actually mean that mortgage rates will rise. Probably haven't got too much more, but just might turn to kind of credit margins for a little bit. We have been seeing a lot of corporate borrowers in New Zealand looking at borrowing in offshore markets, in particular Australia, partially because of cost. We are seeing that credit margins in New Zealand are higher than in Australia and further afield for New Zealand corporates. New Zealand corporates do tend to have reasonably strong kind of balance sheets and can borrow quite easily in offshore markets. But those, I guess that there's, from our perspective at Nikko, it's probably both good and bad. I'll go through some of those. It's good that New Zealand investors benefit from higher credit margins for similar types of credit that they can obtain in Australia or further afield. It's probably bad news that New Zealand companies are doing that because it's and borrowing offshore and chasing lower funding costs, because it takes away opportunities for New Zealand investors. But it's also good news, I guess, from a Nikko portfolio perspective, in that we can invest in New Zealand companies, New Zealand banks, if those companies borrow anywhere in the world in any currencies, as long as we hedge those back to Kiwi. So we have the ability to have the best of both worlds for New Zealand issuers that issue in New Zealand at slightly higher credit margins. We pick those up for the portfolios if there are opportunities to follow those same names anywhere else in the globe, we can look to see whether that actually represents value for our portfolios. And if it does, we have that ability to buy those and put them into our portfolios on behalf of all of our investors. So it is something which is occurring. It won't always occur, but certainly at the moment, New Zealand credit margins are somewhat higher than elsewhere, which is creating a little bit of issuance in offshore markets rather than New Zealand. I might just leave it there and hand back to you, Stu.
Thanks, Ferg. Awesome update. Thank you. The key thing I took out of that was just those references to both sides of the margin story. So hopefully with those deposits coming down for the banks, there may be a bit more mortgage relief than we would ordinarily see from 2 and 3 year swaps, as what I think I heard from you, and your flexibility of mandates, flexibility to take in higher spreads wherever they appear for the benefit of clients. So thank you very much for that.
You're welcome.
Awesome. Let's jump over to Mei Zi Ho, member of the New Zealand Equity team. So welcome, Mei Zi. You are just right on the back of earnings season. It's a pretty big day yesterday, so I won't take any of your time. Please just lead us away.
Kia ora, everyone. Reporting season, as Stu said, is well on its way. So I thought I'll take you through some of the companies that we've reported so far. Gemma, if you want to go to the agenda slide, yeah. I will also touch on the climate-related disclosure, which we are now in year 2 of the reporting cycle. And finally, a quick update on our fund performance. Okay, and on our climate-related disclosures, just wanted to recap on what our learnings are and challenges are to date for ourselves and from conversations from our peers and companies that we invest in as well. So we regularly talk to them and just get feedback on what they're seeing. The good news is it's great to see, traction on fund managers, asset managers, and companies thinking about climate change and reporting on it. The standardization and readability of these reports could definitely be improved, but it's a good start. The climate report formalizes what we already do, in terms about thinking about risk and constructing our portfolios, which includes climate risk alongside all the other usual financial metrics that we usually look at. The scenario analysis part is new to us, and over the past year, we have completed 2 yearly scenario analysis as prescribed by the legislation. We found this useful as we go through the process of what is material to our portfolios and what might pose the biggest climate risk and also opportunities. For example, just to give you one, with the net zero momentum that is still well and alive in New Zealand and Australia, maybe not so much in the US with all the volatility there, we continue to look for winners in spaces like renewable energy or battery-related investments. All this work has provided us as well with a really good base to inform our engagements with our companies. We regularly meet management, as I said earlier, and we also incorporate ESG issues, discussions that are relevant to their businesses. As mentioned earlier, these reports are not standardized, and every fund manager, every asset manager, every company have their own way of reporting it. So as a result, you come up with these sets of reports that do not look the same. In addition, the underlying data could also be, from a third party like MSCI or Sustainalytics, or it could be calculated in-house. There's also often a discrepancy of data and missing data in the reported carbon metrics. As a result, for us as a fund manager, it's often difficult to consolidate all these data, and it's also difficult to digest for layman or a retail investor. And just a reminder, these legislations were written in the first place for a retail investor. We could argue as well that it's costly and timely exercise for the preparers for the benefit that it currently offers the readers. We also see it as a barrier to listing in a stock exchange, especially for a smaller company that does not have sufficient resources or the time needed to comply with these standards. Which brings me to my next point. Over the past year, we have engaged with the FMA, industry bodies, our peers, the External Reporting Board, the XRB, to help balance the reporting efforts out a little, like versus the cost. So in October 2024, the XRB consulted on changes to the audit requirement for Scope 3, primarily due to feedback on the quality of data available and the technical issues around auditing Scope 3 emissions. Just to give you a bit of a background, all of our reported emissions are Scope 3, so those are the Scope 1 and 2 of the companies that we invest in. And, to give you an example, as a data taker, we consolidate companies' reporting emissions into our portfolio. And you can imagine with the different quality and different methodology that this data is driven from or derived from, some even missing. Auditing this is extremely difficult and a bit counterproductive, at least for now, until we figure out how to do it. So the FMA has since approved a classes exemption for climate reporting entities, allowing them to exclude Scope 3 for another year. This is a welcome relief, especially for us as a fund manager. The XRB will also be putting out 2 consultations this year. Actually, the first one's already out, and that seeks information about the value of international alignment to reporting entities and users of financial statements. The second one is due later this year, and that will seek information about the potential need for reduced disclosures for smaller reporting entities and differential reporting options. So just going back to my comment about, smaller companies not having enough resources, having to comply with the full suite of the standards. These are welcome consultations, and we are closely monitoring and engaging with the regulators and our peers on these. So now, moving on to the reporting season. The companies on this slide are just some of the companies that have reported so far. I'll go through some of the key ones in the next few slides and just put our thoughts on these. So first up, we had 2 tech companies in our portfolio that have reported. Serco is an online corporate booking and travel expense company. Their recent results hit the lower end of their guidance and disappointed the market consensus, and also around the expectations of their newly acquired GetThere business. So they recently acquired GetThere by that used to be owned by Sabre. However, they reiterated their revenue aspiration of 250 mil at 2030. They're currently about the 100 mil mark the moment. And we believe they have significant growth potential with their partnership with Booking.com. They run their Booking.com for business for them. Gentrack is a new company in our portfolio, or a relatively new company in our portfolio. They provide software solutions to energy and water utility and airports. The company has flagged this financial year as a transition year, reflecting their long sales cycle. Their financial results also reflected this, with growth and earnings weaker compared to prior periods, and margin at the bottom end of the guided range. The medium-term outlook, though, remains strong, and the market's pricing improving financial performance for the FY26 year. It was also really good to see a new customer win in the UK with 2 million connected meter points. So that's how we measure. It's one of the inputs into our DCF models, for example, to measure their revenue trajectory. And we are encouraged by comments on how well matured the sales cycles are in both the core and the new markets. Next up, we have Aristocrat and Mainfreight, 2 stocks that could give us an insight into consumer spending. Aristocrat is a gaming machine manufacturer. They reported a miss versus consensus EBITDA by approximately 6%, primarily lower due to expected fee per day from the existing machines on the floor and sales in the first half, as their customers waited for a new cabinet to be released in April. Higher development legal costs also contributed to the miss. However, Aristocrat's competitive landscape remains strong, and they have a robust pipeline for the new cabinets, leading to expectations of improved performance and growth in the second half of the year. They have also initiated a relatively small, compared to the one they just completed, a 750 million buyback program, and they completed a 1.8 billion buyback program in Feb of 2025. This should support the shareholder returns in the long run. Mainfreight provided a trading update at the start of the May before the results, so it's pretty pre-guided, which saw the stock perform well then. This result, the results itself reinforce that although it is a mix across the regions they operate in, Australia is performing well, while NZ, US, and Asia struggled. No guidance provided for the year ahead, with April and May described as disappointing, a function of this tariff really uncertainty and the shorter trading weeks for April and May. However, this is balanced by the expectations of a stronger second half performance and strength in Australia. Now, the market was really, really interested in Ryman, as it has continued to perform poorly after its capital raise. This result was a mixed bag. There was a large amount of change in the financial disclosures, so it made it hard to compare to prior period. We received a large write-down as well in NTA, which is how we value these stocks, mainly due to the accounting changes and added conservatives to the NTA calculation. Positively, though, the trading backdrop appears to be improving as Ryman comes out of a period of significant financial and operational reset. The company now needs to move forwards, towards positive free cash flow and set in place in the new growth strategy. If the last two critical steps are achieved and provided economic and operating backdrop are supportive, we just saw the OCR cut, for example, we expect Ryman to be well placed to repay investor patience. Fish and Paykel delivered a strong result, up about 2% above its top end of its previously upgraded as well guidance range, and it was a record result with revenue surpassing 2 billion for the first time. The most positive takeaways for us were firstly a solid increase in gross margin, up almost 2% year on year, and secondly, confirmation that its home care products from New Zealand are exempt from the tariffs under the Nairobi Protocol. This means that the earnings impact from any eventual tariff should be minimal. As a result, Fish and Paykel's gross margin should continue to grow into FY26. Earnings guidance for FY26 was a touch lower than market expected, although still solid. And also worth noting that Fish and Paykel is often conservative with its initial guidance. Infratil is an infrastructure investment company. They reported yesterday. It manages a company-owned portfolio and invests in digital infrastructure, renewable energy, healthcare, and airport sectors. Its result was in line with expectations. The guidance this year ahead, however, is a little bit weaker than expected, primarily due to a push out in its CDC data center earnings. It has noted that there's been a rephasing by its customers, so this has shifted some growth into FY27. Despite this, Infratil maintains its expectations that the revenue will double, or CDC will double its earnings over the next 2 years, with approximately 80% of the forecast revenue already contracted, so that's a good thing. Finally, our month-to-date performance is on the slide. The NZX is down about 6% year to date. However, we are seeing it slowly turning around this month, where it is currently up 3% for the month. Have I take any questions? We'll get back to you after this prezzo.
Thanks, Mei Zi. Yeah, that's a really great update. Thank you very much. As an ex-analyst of three of those last three companies, Mainfreight, Healthcare, and Infratil, I was thinking, oh yeah, always conservative guidance, quite understandable during this time, especially if you tie together what Naomi was saying and what Ferg was talking about. So we're right on time, so I think that we'll stop just here. Just close by thanking everyone for joining us over this presentation. If there's anything you want to follow up on, then please contact us, and have a lovely extended weekend. Thank you very much.